As we analyze how much farther we could go, I found some interesting threads here. Two from Haas. MF Haas on Twitter is the handle. Check out these threads. Get ready for a massive crash. I'm predicting that the S&P 500 and other indices will plummet an additional 40% from their current levels. Here's why. The recent rally was due to a decline in yields as the market thought the Fed would cut rates. But during the last FOMC meeting, Jay Powell made it clear that more rate hikes are likely and the job isn't finished. Yields are now reflecting this and starting to upward trend. This is your 10-year. The yield surge will result in a strong US dollar. I predict a double top or a slightly new high for the DXY. The surge in the US dollar will decimate equities and commodities, leading to a steep and illiquid sell-off. This is your DXY dollar currency index, and you can see what that's going to do here. He's saying one more double top, one more run up. During a bear market, the largest percentage declines often happen after the end, leading to a significant decline in prices. And he's saying that we match up with 1973, 1974 bear market, where we did another 39.66%, so nearly a 40%. And like he's saying right here, with similar megaphone patterns and shared factors of inflation and an oil crisis, if market forecasted steep illiquid sell-off occurs, the market could fall another 40-50%. For the S&P, guys, this is not for our cryptos. If this happens to the S&P, guys, our cryptos, to be honest with you, could get smacked another 60-70%. Even more for some. I mean, some I've been saying, I think go away. Don't even survive this bear market in the cryptocurrency space. But you're talking about the S&P major indices getting smacked another 40-50%? Do you still got your 401k in that traditional 60-40 portfolio? Equities and bonds, worst years ever. S&P, one of the worst years in history. 60-40 portfolio, one of the worst years in history. What are we doing with the 401k, guys? Let me know in the comments down below, because holy smokes, the Wall Street program just gets absolutely smacked here if this continues on. Even the price structure of the Russell 2000 is sending a clear warning. It is in a clear rising wedge formation, which typically leads to a pullback to wave 4. That's the Russell 2000. Then the Federal Reserve's rapid rate hikes are causing lower corporate earnings, hurting consumer spending and business investments. This will lead to a stock market crash as lower earnings decrease a company's stock price and make it less attractive to investors. Our economy's been propped up and running on debt, right? So this is the main thing. Bonds have been in a bull run since the 1980s. I expect one more rally next year due to a recession, but after that, rates will reverse and hit double digits later this decade. This will be a drastic change from the disinflationary environment we are used to. Rising interest rates are a major threat to stocks. They make borrowing more expensive for businesses, which hurt their profits and lead to a decrease in demand for their products or services. Tech stocks are likely to underperform in an inflationary cycle, while sectors such as consumer goods and services may be more likely to benefit from rising prices. Commodities may also be a good option, as they may be able to maintain or increase their value, as we've been saying. Commodities. Got my silver right here. Do you got a little bit of precious metal as well? Commodities may also be a good option, guys. This is not financial advice. This is just this thread here from Haas on what he's expecting. Passive investing through index funds may not be as successful in the coming years as active management. As interest rates rise, we will see shift from passive to active management as the market makes higher lows and lower highs. The end of the supercycle will bring a significant loss of wealth and a long downturn in the stock market, with stock prices falling and new highs in the indices unlikely for at least a decade. The cyclical bear market has begun. This is Great Depression levels. Guys, this is Great Depression levels getting hit, unfortunately. So we got to go through this. And I want you guys to be prepared for that, because I am super excited. I have a lot of energy, as you guys can tell, for this next year, 2023. I'm super excited about it. But that doesn't mean that we're not going to bottom out in the first quarter of this year, or at some point during this year. And, and like I said, crypto is probably going to go first, stocks will follow, and then real estate's probably going to bottom out thereafter within the next 12 to 18 months. For real estate, probably next 3 to 6 months for the cryptos and stocks. So we're still there. We still have more pain to go. As unfortunate as that is, it's been a long year for sure. We're close, though. We're very close. I am your host, Zach Rector. I really appreciate all of the love and support. If you want to support the channel, just remember that you can start by smashing that thumbs up for me, sharing this content far and wide, and everything else is at my website.